Hey guys, welcome to a new video. So first off, some good news in the fact that NVIDIA just announced earnings in aftermarket hours and they beat earnings, and it's kind of been our savior because the market has been pretty bloody bad over the last 2 or 3 weeks. Been hurting quite a bit, and with NVIDIA beating their earnings, so revenue 57 billion, beating expectations of 54.9 billion. That lifts the whole AI and tech sector up because NVIDIA is like the heartbeat of AI and tech. And so it's the biggest stock in the market. So if that goes up, then it usually drags the rest of the market up with it. And that's what we're seeing in after hours kind of trading in terms of share prices. So if you're in the Roundhill ETFs like I am, NVDW is up 6% in aftermarket hours. What do we got? PLTW 5.83%. That's up. AMDW 4.4, and even WHO up 2.5%. So not earth shattering, but still pretty good considering the last couple of weeks have been pretty bad. But so that's some good news. But that's not what we're going to talk about in this video. I'm actually going to compare Roundhill high yield ETFs to REXSHARES ETFs. I've been keeping an eye on REXSHARES a lot recently because they do seem to be the other big player. YIELDMAX seems to be on the downward spiral, and Rex and Roundhill seem to be the two guys that are delivering well in terms of total returns and results. So that's what I wanted to compare. Rex haven't had as many ETFs out, but they're starting to release more, and they've released quite a few more recently. We'll talk about that, but those are the two that I want to compare today. So I'll just do a bit of analysis on that. But first, a disclaimer, of course, this video is not financial advice. This channel is purely based on my thoughts as I navigate my own personal investment journey. Please, please, please always do your own research. So with that being said, let's get into it. So REXSHARES, you may not be as familiar with them as Roundhill because Roundhill seems to be the popular player at the moment. Roundhill is the one that I'm invested in, but Rex did until recently just have these four kind of core players in, I guess you'd call it the high yield space, but actually it's growth and income, as is the Roundhill weekly pays. They are growth and income. They do both. They're leveraged. And that's kind of similar play to Rex. They have these four key players, so Coinbase, MicroStrategy, NVIDIA, and Tesla, and they've just released these guys as well. But similar to Roundhill, there is a slight amount of leverage, so they target 1.25x returns on exposure, and they use half of their portfolio seeks to generate weekly income via a covered call strategy, and the other half remains uncovered, allowing for uncapped upside potential. So I kind of see these guys as like a merge between YIELDMAX and Roundhill. They're using covered call strategy, but they're also using a bit of leverage. So they've got uncapped upside to a certain amount, but they're also using covered call strategy to create all that income. But then because only half of it is kind of uncapped, there's also a bit of a limit on the downside. The downside is probably not as heavy as it will be on Roundhill, because Roundhill is essentially a pure leverage play. If we look at Roundhill, it's basically a bullish exposure and weekly distribution. So what is it if we go down here? Weekly distributions, enhanced exposure. It's amplified returns of 120%. It's basically a leverage play of 120%. And it's going to use the leverage and swaps to pay distributions, but also have that uncapped upside. So if NVIDIA goes up 10%, it'll go up 12%. But if it goes down 10%, then the Roundhill ETF NVDW would go down 12%. So there's that risk on the downside, whereas there's a little bit less risk with the Rex ones because only half of the portfolio remains uncovered, allowing for that uncapped upside, but also it protects the downside a little. So it's a little bit more conservative in a way, even though there's leverage involved. So, Roundhill definitely seems to be the bigger player at the moment. It has more ETFs. It's been releasing a lot more. I'm very bullish on a lot of them. I've been buying the dip on a lot of them. I've actually been buying Meta because I think that's at a great price at the moment. And I'm trying to move away from very heavily exposed to crypto, Coinbase and MSTW, and I'm trying to buy more of the Metas. Obviously, WPAY, very bullish on WPAY. And what else have I been buying? That's pretty much it. Meta or Amazon. I think that's going to do pretty well over the next 6 months to a year. But anyway, let's get into a comparison. So what we're going to do is compare these four, because these are literally just launched. So the only fair comparison is if we do these four main players that Rex have had launched for quite a while now, and if we compare them to obviously the Roundhill versions of those ETFs. So it'll be COII, so this is Coinbase COII versus COIW. So this is the Rex one, and this is the Roundhill one. Now we're doing total returns, so that's share price as well as distributions. So total return, that's what I always look for because that's what we want. And it's over max time. So we won't go all because it's an unfair comparison. We've got to do it from when when the last one was launched, which was COII back in June sometime. So we take this whole period, and you can see that in orange, the extra leverage of that uncapped upside plays well into the Roundhill one of COIW, and it was up 75% versus 48% back in July time. But then overall, because it's been so volatile and the market's been pretty bad recently, that difference has come down. Now, Coinbase has had a pretty good 6 months. It's been bad actually for the last month or two. Very bad. As you can see, returns down 6% if you're holding COIW, which I am, versus COII, which is down 13%. So in this example, for this one, so for the Coinbase one, even though the leverage is uncapped, for the Roundhill one, COIW, it still takes the win, even though we've had quite a bit of downside recently. It's still a better total return, even though it's poor performance, than COII, which is the Rex one. So it's kind of 1-0 to Rex, if you like. Now we'll go on to the next one. Now, MicroStrategy. This has been performing really badly. I've been DCAing into it probably too much, and so I'm a bit too overexposed on it, and it just keeps dipping and dipping and dipping. You think it's going to rebound, and it doesn't, but I'm holding. I'm definitely not selling when it's this low because I still believe in it fundamentally. But anyway, so this is basically downside. So this kind of shows that the downside of that extra leverage of MSTW, because it's a pure leverage play, Roundhill, it's down more. It's down 63% versus 57% for MSII, because their downside is a little bit more cushioned because only half of their portfolio is exposed to the underlying. So when there's downside in play, the Rex option is a little bit safer in that sense. They have less exposure to the downside. So in that sense, Rex would win this one. So it's 1-1 kind of. If you want to keep score, it's 1-1, right? We go into NVIDIA. So this is kind of a key one because this is NVIDIA is much more stable than Coinbase, than MicroStrategy, than even Tesla. It's kind of the stock market kind of goes by what NVIDIA is doing, really, but it's much steadier in how it performs, much less volatile. So you can see the differences are hardly anything. It's 45% to NVII, which is the Rex one, compared to 43% of NVDW, which is the Roundhill one. So very negligible difference. They're both doing really great. I mean, if you're holding either NVDW, which I am, or NVII, you're doing really well, like 43% or 45% total return in the last, not even 6 months is a really good return. So well done if you're holding both or either. But I think this just goes to show that their performance when we're in a steady market is pretty similar. But Rex just takes the win, even though it's been mostly upside, which is quite interesting to me because I feel like the Rex ones do better in a down market. But even when we've gone up quite a bit, Rex still takes the win. So it's still 2-1 now to Rex. But I'll just show you what, the reason I'm comparing these two is because, in my opinion, they're the best two of the high yielding ETFs. So if we take the YIELDMAX one, we'll do NVIDIA, and you can see 32% total return. If we do NVIII, even though it's got crazy high distributions, basically doesn't capture any upside. So that's why I stopped investing in it. I did a video on it a while ago about how I sold off all my GRANITESHARES ETFs. And this is kind of why, because even though NVII has really good high distributions, it's upside, it just doesn't really capture any upside. So its NAV just declines, it just erodes away week after week, basically. And YIELDMAX obviously doesn't have that uncapped upside. Its upside is capped, so it just doesn't have that, I guess, upside that either NVDW or NVII have. So for me, my two preferred players in this market at the moment are REX and Roundhill, and that's why I'm covering. And this kind of shows it. If you think of NVIDIA as like the most stable big tech ETF to cover, then I think this is quite a good example of where each of these players is sitting. And so for me, I'll just take out NVII. I think it's too risky. The distributions are too high and it just can't recover. So I take that one out. And NVIDIA, I just don't like the fact that YIELDMAX ETFs have such capped upside. Like essentially, if NVIDIA goes up 10%, then YIELDMAX ETF NVIDIA will go up 6 or 7%, whereas the NVDW will go up 12%. Now, there's risk to that because you're using leverage. There's enhanced exposure. But if you're buying well, if you're buying down here or in the dips down here, then that's going to work out well for you. If you just want to DCA in over time, then maybe YIELDMAX or NVII, because its downside is a little bit less than NVDW, is the better player. It depends on your strategy, but I'm quite an active investor, and so I've been buying quite a bit in this dip over the last week or two, and that's how I like to do it. So it really depends on your strategy, but for now we're just comparing these two, and essentially from the first three, it's 2-1 to REX. So they seem to, even though they're just pipping it here, they're winning. But then we moved to Tesla. So we got, when did TSII launch? In June. So in blue here, we have TSII, which is the REX ETF, and in orange, TSLW, which is the Roundhill ETF. And as you can see, this is the one with the most difference. We've got 30% upside, 30% total return for TSII, and 16 or 17% for TSLW. So yeah, there's quite a bit of difference there. And that leads me to think, I don't have a lot of exposure to Tesla at the moment because I sold my Tesla position and I've been looking to get into it. But I think when I do, even though I've got mostly Roundhill ETFs, I'm probably going to get into the REX one simply because I feel like its downside is a bit more protected, and it seems it's got that upside, but it's got slightly more protected downside. So it's 3-1 to REX. And as you'll see, look, the downside is REX, but then when there's big upside, so if you're buying really well, so if you buy here, I'll just try and do a thing. So this is now back to the Coinbase one, and you go to here, then you see the difference in upside when you're on a big rally. So it's 54% total return for COII, whereas 85% for COIW. So if you're super bullish on a stock and you want to take that extra bit of risk, that extra bit of leverage, then you go Roundhill. If you're not sure, if you're going for more of a stable return, then maybe REX is your guy, is your player. So it's very interesting. So yeah, Coinbase was the only one where Roundhill won, and the rest, it was REX that have better total returns than Roundhill. And some people might find that, surprising, because Roundhill has been the star player. Even myself, I've been investing more into Roundhill because I'm trying to buy the dips and to try and take an advantage and the opportunity of all the upside to come. And that's kind of what I've been doing. And it's been working pretty well for me. But if we suddenly have a big move to the downside, there's a lot of risk involved with that. So I'll just leave you with this. So I asked so there's a lot less downside risk to the REX ETFs. And they said, yes, in general, the REX growth and income ETFs are structured to have slightly less downside risk because about half of each REX's funds portfolio is covered by selling call options and how they make their income, and the other half of the portfolio remains long. So you still participate in the downside, but only on that portion. So you're only getting downside on half of the position, so to speak. So 50% of the full downside moves minus the weekly income received. So whereas the Roundhill ones, they're fully leveraged. It's like a leverage play. It's 1.2%, 1.2 times exposure. It goes up 10%, you go up 12%. It goes down 10%, you go down 12%. So in summary, REX ETFs, milder swings, steadier income, less downside risk. So if you want a bit less risk, and I think these high yield ETFs are quite risky, so I'm actually thinking about trying to open new positions in REX, especially during maybe times where we're not sure if the market's going to go up or not. Like, it's been very volatile recently, and I think the Roundhill weekly pay ETFs are quite risky, even though I'm quite heavily exposed to them, because I try to buy the dips. I do worry about the downside and a bear market. If we go into a bear market, we're going to get wrecked in the weekly pay ETFs. So I do think this is quite important. So REX ETFs for milder swings, steady income, less downside risk. Roundhill weekly pay for pure leverage play, more upside and more downside. So definitely riskier. So I just thought this was really interesting because I am heavily exposed to Roundhill. So I've been moving a lot of my positions from YIELDMAX into Roundhill. I've sold off all my GRANITESHARES positions, but I think I'm going to start opening up now that REX have started launching some more ETFs. I've got my eye on this guy here, so COIW. It's like AI and tech, but all of these are the big players that everyone loves: Robinhood, Palantir. And then this is Walmart and what's LLY? I don't know what LLY is actually. Probably should know, but I don't. If anyone knows, let me know in the comments. But it's good to see that they're launching some new ETFs because I think I'm gonna start moving some, or at least opening some positions into these REX ETFs, because just in case, just to protect that downside a little bit more. So you've still got a lot of that upside, you've still got decent distributions, but you're not getting so much of that downside risk. Now, there is, I guess, one thing to note is that the distribution rate is quite different. So like the Roundhill ones, where the distribution rates fluctuate massively depending on what the market's doing, it's similar for this. So TSII is paying 100% at the moment, over 100%, but MicroStrategy and Coinbase, which have been doing terribly over the last couple of weeks, are only paying 28%. So if you're chasing those high yields, which I personally don't like to do, I like to go for total returns, then this may not be for you. You may be looking at just at TSII, or you may be looking at, just some of the other players in the space, because the distribution rates are going to swing quite drastically depending on what's going on with the underlyings in the market at that time. So that's something also to consider. But I just thought this is worth pointing out, as I think a lot of people are focused on Roundhill at the moment, and I think REX is a really, really good player in this space, and are definitely worth considering. So I'll leave it there, but let me know what you think in the comments, and if this was of value, please give me a like and subscribe, and I will see you in the next one. Cheers.